What's going on, guys? Welcome back to the channel. Welcome back to another video. Ron Yates here. Hope you guys are doing well. If you're new to the channel, if you're stopping by the channel for the first time, please consider subscribing to the channel. And while you guys are at it, go ahead and smash that like button. Thank you in advance. So guys, I want to talk to you guys about these banks, right? Now, I've been in the financial markets for 25 years. I've been an investor. I've been investing in stocks, independent businesses, real estate, you name it. And I've been watching what is happening lately. The Federal Reserve has been raising interest rates, and we've been seeing multiple banks collapse as of recent years. As of recent months, I should say. Some of the banks that we've already seen collapse are Silicon Valley Bank. I think it was First Republic Bank. We've seen Credit Suisse also fail. And now Credit Suisse is a European financial institution, but there was another U.S. bank. You guys can correct me on the bottom and the comments down below. Let me know what that third U.S. bank was that collapsed. But thanks to the Federal Deposit Insurance Corporation, aka the FDIC, many of the people who were invested in Silicon Valley Bank or had deposits in Silicon Valley Bank, both independent or individual account holders with checking accounts, savings accounts, business owners that had their business bank accounts with Silicon Valley Bank. Many people actually had, in fact, a significant number of account holders had bank accounts with Silicon Valley Bank that exceeded $250,000 in them. Now, this is a tremendous amount of risk that these policy holders, like as we're talking about insurance policy, right? This is a tremendous amount of risk that account holders took on that may or may not have realized the amount of risk that they were taking on by having more than $250,000 in the banks. So when the bank collapsed, if FDIC didn't take it upon themselves to save the banks, to save the honestly, in my opinion, they didn't save the banks so much as they saved the deposit holders. The deposit holders, the account holders, really got saved. And I don't understand why so many people are really upset about the Fed or the FDIC saving Silicon Valley Bank, because a lot of people, not just businesses, not just the wealthy individuals, and in my opinion, you're not necessarily wealthy by having more than $250,000 in there. I mean, think about it. Retirees, the average retiree retires with like around $250,000, $300,000 in net worth. So a retiree, just think about it. Imagine your grandparents, all they have is $250,000, $300,000 to their name, and they have money in a bank, and all of their net worth is in this one bank, and that bank fails. Grandma or grandpa's in a lot of trouble. So I'm actually very happy that the FDIC stepped in and not only saved made everyone whole, but also those who have more than $250,000 in there. So it's not just the wealthy, to be honest with you. But you got to ask yourself, well, what's going to happen next? Now, we've already seen what kind of has already rolled out so far. Essentially, what we've seen is a tremendous boom in the real estate market. I'm going to go ahead and get out this car because it's getting kind of hot. But there was a tremendous boom in the real estate market. And this boom was brought on mainly due to a drastically reduced interest rate, which made loans, borrowing money very, very inexpensive. All right. And so what happened is this money ended up going in, and this is what they call like stimulus money, right? Well, or quantitative easing. Well, this money went a lot of different places. This money went into a lot of assets, and this ended up creating what many refer to as an asset bubble. This bubble of assets inflated real estate, the housing market, the stock market, cryptocurrencies, all sorts of different assets went up in value. And so this money had to go somewhere. People bought a lot of cars, automobiles, SUVs, luxury automobiles, you name it, trucks. They couldn't keep diesel trucks on the lot. They couldn't keep Ford F-150s on the lot, right? Anyway, and so with that, we saw a drastically increased collection of assets. Even the depreciating assets such as automobiles all of a sudden we're appreciating. Like I ran into so many people with, stories coming to me telling me, hey, I had a used car or a used truck that I traded in. I had it for 2 or 3 years, and when I traded in, my trade-in value was higher than what I paid for it. I put 20, 30, 40,000 miles on it. It was unbelievable. That's not going to happen today. But the question is, what's going to happen next? Are we going to see another 2000, 2008 collapse? We very well could. I mean, if we think back, remember, you guys remember Wachovia? Well, Wachovia essentially collapsed back in around the 2008, 2009, 2010 timeframe. And Wells Fargo stepped in and bought that bank up. That essentially saved a lot of individuals, I won't say really saved the investors, it really saved a lot of account holders. And so that's what we saw back then. I would say the 4 top banks in the United States right now are probably Bank of America, JP Morgan Chase, certainly Citibank. I guess we could put Wells Fargo in there. It's kind of hard to name another bank that's really bigger than Wells Fargo. So I would probably list Wells Fargo as bank number 4. So now the question is, you might be asking me, how am I going to protect myself? Well, the way I'm going to protect myself, the way I am protecting myself, is I have multiple bank accounts. Now, not only do I have multiple bank accounts, but I have multiple bank accounts at different banks. So I don't want to be limited to a FDIC limitation of $250,000. Because you got to remember, these banks, they're going to take your money and they're going to invest it in whatever they want to invest in. Now, obviously, their goal is to invest in something that's going to give them an expected rate of return that is higher than what they're paying you in terms of the interest in your bank account. That's why they're paying me and you pennies, right? Now, I do have some high yield savings accounts, money market accounts that are paying well over 4% right now. But I understand that these rates are variable rates and that they're not locked in and that they're not necessarily going to continue to pay this amount. These interest rates that they're paying me, they could change at any minute. They can go up, they can go down. Thing is Silicon Valley Bank got caught with their pants down because the Federal Reserve began to raise interest rates, and they raised interest rates so quickly, so fast. Meanwhile, Silicon Valley Bank was taking in deposits, and thanks to fractional reserve banking, they were allowed to only hold on to about 10% of the money that was ever handed to them through customers' account deposits. So for Silicon Valley Bank, they invested a significant amount of money into short-term 2% interest yielding bonds, treasury bonds. So when the Federal Reserve, and they're locked in for anywhere from 1 to 3 years. So when the Federal Reserve began to raise interest rates, the values of those bonds began to go down drastically. Now, ordinarily, you might think to yourself, well, treasury bonds are pretty safe. I mean, historically speaking, if you put money into a U.S. Treasury bond, you've never in the history of America, in the history of the United States banking system, ever lost any money. So on the surface, it's a fairly conservative investment, but you got to look at all angles, all aspects. And unfortunately, as much as these executives and accountants and bankers are being paid over at Silicon Valley Bank, they underestimated the risk associated with what would happen if the Federal Reserve all of a sudden decided to raise interest rates. What kind of situation will we be in? Secondly, what kind of situation will we be in if all of a sudden lots of account holders wanted to come in and withdraw their money from the bank? We could be caught with our pants down, thanks to the very tool that allowed them to make these investments, fractional reserve banking. See, the problem is fractional reserve banking allows the bank to invest 90% of the deposit that you make. So as long as the depositors don't all come back at the same time and request too much money from the bank, as long as all these depositors don't come out and take too much money from the banks, fractional reserve banking works just fine. Well, I would say that the other variable, the other stipulation is assuming that the investments that the bank's making with that money is panning out for them. Like, just imagine what would happen if there was a combination of a large number of account holders looking to withdraw their money from the banks and the investments that the banks had made went sour. I'll give you a great example. Just imagine what would happen if, the real estate market suddenly began to collapse, which in and of itself is not necessarily a problem. But let's just say if the real estate market had a significant downturn in terms of a collapse driven more so by labor. And we're already seeing this right now, the labor market. Microsoft, Walmart, Bed Bath & Beyond, Redfin, Shopify, like the list goes on and on and on for companies that have commenced with layoffs. So imagine all of these different tech jobs, all these different tech companies laying people off left and right. These are generally high-paying jobs. So, these are good jobs. So when people lose a job, I'm willing to bet that the average tech earner, especially in California, is going to be earning at least $100,000 a year. So these are big mortgage payments that may not be able to be made. A lot of people started making a lot of money very quickly, got very confident, saw their home, their real estate, their primary residence, real estate appreciate in value super fast. And with low interest rates, many people were buying homes, large homes, mini mansions, So just think about it. If these banks all of a sudden stop receiving mortgage payments from a large percentage of mortgage holders, well, what do you think is going to, how's the bank going to feel? The bank's going to get real tight because that's going to affect the bank's cash flow. So guys, one of the things, me personally, I've always invested in the stock market for a long time. ETFs, index funds, mutual funds, 401ks, individual retirement accounts, IRAs, Roth IRAs, traditional IRAs, and I invest with a number of different companies. And the reason being, and I talked to my banker the other day, I talked to one of my investment advisors the other day. She was telling me, your investments are complicated. You're all over the place. And I'm like, they're really not complicated. Now, by the way, if you guys are wondering what is all this in my mouth, somebody said to me the other day, look like you got dip in your mouth. I don't have dip in my mouth. I had surgery not too long ago, and my mouth is still swollen, in case anybody was wondering. Anyway, so she said to me, your investments are complicated, you're all over the place, and it's like, I'm like, no, they're not complicated. I may have a lot of accounts, and they may be with many different institutions, but it's fairly simple, if you ask me. It might be complicated for someone else, but for me, I've been doing it for 20 years. Been having many different accounts, many different financial institutions for the last 20 years. So not only do I diversify my investments, not only do I diversify my assets within the stock market, I'm not going to invest all of my capital into one stock. I just won't do it. That's one of the reasons why I prefer ETFs, index funds, mutual funds, though I do invest in individual stocks too. But the key is it's a lot of different ETFs spread across several different investment companies. You might use different investment brokerages such as E-Trade, Webull, Robinhood, M1 Finance. You're creating diversification through different brokerages and also diversification through different ETFs and stocks. And so you're protecting yourself in that method. And I take that same strategy and I do the same thing with the banks. I'm not going to have all my money in one bank. I think it's kind of silly, especially when you look at the risks associated with it. And even if we weren't in like some crazy environment where, banks are at risk of collapsing any day, right? I think it's still wise to do. Why? Because I think it's a great idea to build credit, to build a rapport with a number of different banks, because different banks offer different benefits. I think it's great to have, an account with, and the funny thing is even though I would probably say Bank of America, JP Morgan Chase, and Citibank are probably like the top three, I still have an account with Wells Fargo. I have an account with all of these different banks, but it doesn't end there. I have accounts with credit unions, all sorts of different credit unions outside of the state where I reside. I think it's also wise to have businesses, and then within your business, you create an LLC, create an S Corp, C Corp, whatever the case is. Have your business bank accounts in multiple different banks too. Like, I've always been taught as a kid, never put all your eggs in one basket. And this is not the first time you guys have heard that, right? So the same applies. So, I'm not going to sit around and wait for the next collapse. I'm going to make sure I take action now. Now, the other thing is so Wells Fargo, Wells Fargo ended up purchasing Wachovia back in 2008. I think I'm forgetting which banks were involved in providing liquidity to Silicon Valley Bank. I want to say Chase was involved, maybe $1 billion from Chase, maybe $1 billion from Bank of America. But whatever the case is, you guys got to remember, not only through diversification do you protect yourself during times of financial crisis and potential economic collapse, but the other thing is that you're putting yourself in a position so that, and a lot of people don't even consider this or even know about this, you're putting yourself in a position so that when a competitor fails, you got to understand, when a competitor fails, that competitor was serving a segment of the market. So when Wachovia failed, Wells Fargo acquired all of those customers in an instant, overnight, for pennies on the dollar. So if you're invested in Wells Fargo during that time, you were likely rewarded handsomely. So keep that in mind, guys. When Bed Bath & Beyond goes down, you got to know that Bed Bath & Beyond was serving some degree of customers. Now, obviously, they didn't have enough customers to stay in business, but whatever customers that they're losing, some other existing business that is surviving is going to get those customers. Whatever businesses are surviving are likely going to come in and be able to scoop up Bed Bath & Beyond inventory for pennies on the dollar. Whatever they don't sell to consumers, with their closeout sales and, out of business sales and whatnot, whatever assets remain. And heck, maybe they're already doing this now. I wouldn't be surprised if, Bed Bath & Beyond receive all sorts of offers from competitors looking to just get great deals, knowing they need to liquidate all of their inventory. So anyway, guys, it's all about protecting yourself, being smart with money, building wealth, diversifying, and and making smart moves. So let me know what you guys are thinking. Drop me some comments down below. Drop a like for the video. Also subscribe to the channel, and I'll see you guys on the next one.